With energy markets already under pressure, the Strait of Hormuz is no longer just a shipping route. It is rapidly becoming a geopolitical pressure point with global economic consequences.
All right, and moving on, the global trade system since 2020 has been shaped by COVID recovery, the Russia-Ukraine war, Gulf disruptions, and a global push towards strategic trade alliances.
And in this scenario, how are the world's largest economies growing and where is the growth concentrated? For China, the growth is focused on manufacturing, exports and industrial scale. Its dominance in sectors like electronics, batteries, electric vehicles, solar panels and machinery has helped Beijing maintain trade momentum despite tariffs.
Now, the United States, meanwhile, has relied on consumer spending, technology leadership, financial markets and energy exports. The AI boom and America's dominance in high-value services and semiconductors have supported growth even amid inflation and geopolitical uncertainty.
Now, beyond leverage, what shaped the economic trajectories of the two economies is a more protectionist US and a more strategic China after 2024. When Trump imposed sweeping tariffs on the world last year, including China, the idea was to leverage the key role US plays in the global supply chain. But over time, the trade war produced a more complicated outcome.
Instead of collapsing, China's export machine adapted and diversified. Chinese companies expanded deeper into Southeast Asia, Latin America, Africa and Russia, reducing reliance on the US markets while strengthening alternative trade corridors. And this coincides with the global consensus among leading economies, including EU, of the US's unreliability in trade agreements. As a result, China is now a major trading partner for more than 150 countries and regions, with exports of high-tech products continuing to rise.
Now, despite a weakening domestic economy and a crumbling property sector, China's export engine continues to power its growth. Meanwhile, the IMF cut US growth forecasts amid tariff uncertainty and slowing domestic demand. American GDP growth projections for 2025 were lowered towards the 1.8 to 2% range as tariffs raised import costs and created supply chain disruptions. The Iran war is already adding pressure on consumption, with inflation rising to dangerous levels.
Well, tariffs may have reduced direct US-China trade dependence, but they also push China to become more globally diversified, more export-oriented and more deeply embedded across emerging market trade networks.
Speaking of growth, China's global yuan ambitions are also at the center of a coordinated decoupling from the US dollar. While the US currency still powers global finance, alternate payment channels are emerging, with yuan leading the way. And this was on exhibition recently when Iran allowed yuan payments for ships passing through the Hormuz Strait. The simultaneous rise in yuan and conversation around de-dollarization could shape the global financial system.
Now, what has changed since 2020 is not globalization itself, but the structure of globalization. Countries are now prioritizing supply chain security, strategic partnerships and economic resilience over pure efficiency. The result is a new global trade order where both Washington and Beijing are fighting for the bigger prize.